Hi guys. So in this video we are gonna discuss something about investment controls and associate joint ventures, subsidiaries, what that mean and how we should recognize or in the books of accounts and how we can identify whether whether that investment qualifies for a subsidiary, an associate or a joint venture. Look, in my point of view, the first thing one should understand that when they go for an investment, if they have investment, for example, there's an hypothetical company called X Limited. What he did is he just acquired some investments in the term, I would simplify the situation, some equity shares of Z Limited. From that equity shares, it might have derived control over the entity, or due to the investments in equity share, it might have significant influence in that entity, or due to the investment, it might have certain joint control over the entity, or it might have just a simple investment, nothing else. It's just a simple investment, nothing else. So first thing first, you need to understand what the investment is. It's an investment in equity shares, and from that investment, what you are gaining. Either you can gain a control over the entity, or you can have significant influence over the entity, or you can have a joint control over the entity, or you can simply make an investment. If you have control over the entity, it will become your subsidiary in most of the cases. If you have significant influence over the country, over the company, then it will become your associate. If you have joint control, it will be a joint arrangement. Now, the control is over either you have control over the net assets or you can identifiable assets. So now it depends upon the two circumstances. You need to classify either as an joint venture or a joint control operations. Now the fourth one is if you do not qualify any of these residual category or simple investments, which is going to be a financial instruments which could cover under IAS 39 or IFRS 9. So why it is important? You need to analyze if you have control, it will become your subsidiary. If control's definition is given under IFRS 10. So when I was discussing IFRS 10, I will be going in detail about the controls, because the entire IFRS 10 runs for the control. What control means, if you have this, if you have that, then whether it should be a subsidiary for you, or whether it should be an associate for you, or whether it should be a simple investment for you. I've seen many cases where an entity is having around 60% investment, but still they don't have a control over the entity, and they are still treating as an associate because they might have a significant influence because of their equity interest in the entity. But if you have control, you need to treat it as a subsidiary, and in your separate financial statement, IAS 17 deals with your separate financial statements. I will deal with okay, look, separate financial statement is a subset of individual financial statement because it's very wide. I'll discuss the concept of separate and individual in some later videos because it will take time. Now, if you have control, you will classify as a subsidiary and you need to prepare consolidated financial statement for that. If you have significant influence, it will automatically become your associate, and you need to apply equity accounting as given in IAS 28 for the purpose of recognizing your interest in your consolidated financial statement. And there is option available for the entity in their separate financial statement to use equity method. I will discuss this matter when I will discussing IAS 27 in a detailed manner, because the third one is a joint control. Joint control means you cannot take any decision on your own. If you want to take any decisions regarding the day-to-day operations, I'm not talking about 75%, 80% voting rights is required under Companies Act like that. If you want to make decisions about the operations of the entity, and you cannot make a decision on your own, and and the decision should be made unanimously by all the members. Then in such a case, it will cover as a joint control. Suppose there are three members, there are three participating members. None of them are sleeping, they are actively participating in the businesses. And if two says yes, one say no, no decisions. If three say yes, it's a unanimous decision. Then the resolution gonna pass. The purpose for which they're passing the resolution gonna occur, which means they require unanimous decision making. So then in such a case, it will cover under joint control. And if you do not qualify for anything, it will be a simple investment. And if it is an equity instrument, it may be through OC. It should be through profit loss, the fair value through profit loss account, and under some conditions, it might run through OCI. But there are certain conditions. I'll go by the conditions when I'll discussing about the IFRS 9. So what does control means? When I am discussing, I'll discuss the entire subject in IFRS 10, but as it gets a brief, I can say that when you are thinking about a control primarily means three things, three conditions. If an entity has three conditions satisfied, then in such a case it can say that it has control over the other entity. For the first condition is it should have some power. The second is from that power, and the second condition is it is exposed to variable returns, and third, through the power it can affect the variable returns on the performance of the entity. The three conditions, my wordings might vary with the standard, but the context is same. You have power if you have exposed to variable return, and through your power, if you can if you can change as per your will the variable return. For example, dividend distribution. If you have more than 50%, and you can do whatever you want to do for dividend. I'm talking about at ceteris paribus, not talking about any stock movements and stock inflations that might occur after your dividend decisions. You might not have 50% voting, but you have influence. Influence means your participation. If you have the power to participate in the relevant decision making of the entity, I'd cover under associate. And for associate, we have IAS 28 and deals with the equity accounting. And for joint control might be joint control deals with a joint arrangement. A joint arrangement will two type. It will be a joint venture or jointly controlled operations, depending upon what you control. If you have control over the net assets, I'm talking about net assets, not about the identifiable assets. If you have control over the net assets of the organization, then in such a case you will apply equity accounting. If you do not have control over the net asset, but you have control over the specific assets, you will add the revenue from the specific asset, your pro rata. You will show that asset in your books of accounts as per your shares or as per your assets. So we will discuss it in much detail later on. And thanks. That's all, I guess. I'll discuss each and every point in my later videos. Thanks.